Before you go in debt with your business, you want to watch this video. Hi, I'm Erica from Paragon Accountants, where we offer tax strategy and CFO services. Today, I'm going to share with you the pros and cons of getting a loan or line of credit for your business. So let's begin. Loans versus lines of credit versus credit cards. There are two main ways that a business can get money from a lender. Number one, a loan or a line of credit. Loan has a non-revolving credit limit, so you get a chunk of cash once, and then you make interest and principal payments until it is paid off by a certain due date. Because loans are more fixed, they often have better interest rates and terms, but that varies depending on your lender. On the other hand, a line of credit has a set limit, and the borrower has continuous and repeated access to that line of credit while it is active. You don't have to use it at all, and you make monthly payments on the interest and principal. Credit cards, for example, are a common form of line of credit. You have a base amount you have to pay each month to avoid penalties, and you can charge up to a certain amount total. And you can use it again and again as long as you have the account and pay the debt down. But while all credit cards are lines of credit, not all lines of credit are credit cards. While terms vary depending on your lender, the APR, or percentage you pay in interest, is often lower with a line of credit at a bank, and the limit is usually higher than that of a credit card. That makes loans and lines of credit a better choice if you plan to borrow a large amount of money and pay it over time than a credit card. Credit cards often offer things like rewards and cashbacks, which make them a better option for a short-term borrowing period that you would pay back at the end of each month, like regular operating expenses. Loans, lines of credit, and credit cards all can affect your credit score, both personally and as a business. So be sure to talk with your CFO if you want to see the best option is before choosing one or the other. Instances where taking out a loan would be beneficial would be like expanding a new physical location, buying new equipment, making mass purchases of inventory, especially if it would save you money in bulk purchasing. But keep in mind that debt is good if it will produce a larger profit in the future. In these instances, lenders may be more willing to provide better loan terms as you can show the direct benefit to the business itself to a banker. There are other instances, however, where it might get a little trickier deciding whether it is a good idea to take on debt in your business, such as hiring new team members, starting a new business venture, or branching out into a new market you haven't been in before. These can be harder to pinpoint the return on investment, or ROI. So a loan company or underwriter might be a little more reluctant to provide a lending opportunity or better terms. As a CFO, we can help you run the numbers and determine what kind of loan and how much would be good for you and your business. What to consider before taking out a loan. Things such as your sales and revenue over the past 12 months, your current cash flow and cash forecast for the next 12 months, your operating needs and long-term goals, economic conditions and how it might affect your business, and the area of the market you are in, the terms of the loans or lines of credit, and don't forget to factor in the interest rates. You're not just paying back the loan, you're paying it back and then some. So when you're making calculations, be sure to include that in your budget. Your CFO can help you to run the numbers and look at any hidden costs that you wouldn't know to include. Alternatively, if you're nervous about taking out a loan or your ability to pay it back, here are some alternative options you can do to help raise the capital you need to expand your business. Number one, raise your prices, especially if you haven't adjusted for inflation and your loan is simply to cover the cost of rising prices. Bring on a partner. This can include someone who works in your business and or someone who invests money into your business. Crowdfunding. This is a great way to get money now and to develop a product and then deliver it at a later point in time. Grants. There are hundreds and thousands of dollars for grants offered to businesses each year. So start with a Google search of grants in your area. The Small Business Administration Fund. This is a great way to get free coaching and low interest funding if you run a small business. Or rent or borrow community resources. Instead of buying an expensive piece of equipment, you may need to or may want to consider renting as an option in the short term. One of the best ways to leverage capital in your business is understanding tax strategy and making sure you're leveraging all the tax benefits available to you. We here at Paragon Accountants always suggest that business owners meet with their CFO and tax strategist at least quarterly to make sure that they are making the right payments and leveraging tax benefits as much as possible. If you're thinking about taking out a loan or a line of credit, you'll definitely want to meet with your CFO beforehand to run the numbers and see what it would mean for your business and your bottom line. We'd love to hop on a call with you and help you figure out if a loan is right for you and the expansion you may be considering is the right time. So contact Paragon Accountants today to set up an appointment. We look forward to hearing from you. And again, please like, subscribe, and share our video as we're here to help educate business owners and build their financial future.